A very good morning to all of you students. My name is CA Devas Gupta, and today we will be continuing our discussions on the revisionary aspects of derivatives. Sorry. So students, till our previous session, we have covered within derivatives, forwards and futures. We have discussed about their basic concepts. We have also discussed about the valuation of how the valuation of a forward or a future will take place, which is based on some of the very basic compounding formulas. And accordingly, we have also discussed about the hedging technique in which the forwards and futures can be used. Now, today, let's extend our discussion towards the further topics in derivatives. So, let's start with options today. So, options are also one of the form of derivatives which are considered to be a version from a perspective of holder. The holder of the option is the buyer of the option, will have some option, will have some choice, or that person will can exercise that option if he or she wants, or that person cannot exercise that option if he or she wants. Okay, so the option by nature itself is a choice. Now what sort of choice? Let's discuss that. Let's say A is a financial instrument. By financial instrument, we mean it's a financial contract, right? Within that contract, there is a mention of a right, there is a mention of, let's say, a privilege. Because see, contracts generally mentions what? Contract generally mentions rights and obligations, right? So this contract is mentioning about the rights and those rights, which we can also say as a privilege, or it's not an obligation, not a mandate, right? It's a right of what? Right to buy. Okay, so there is a right to buy. If I want, I can buy. If I don't want, I can skip buying, right? I have a right to buy. I don't have an obligation to buy. Okay, I'm just again and again emphasizing on this because this is the only premise on which the entire option concept is built. So A is an instrument which gives a right to buy what? An underlying asset. Underlying asset means that this is a subject matter asset which is in question to be bought or sold. Correct? So that underlying asset will be specified in the contract and even at what price the buying will happen is also specified in the contract. So you assume a situation that I am, let's say, a procurement manager of a company. I'm just extending the previous discussion that we did in forwards and futures. Now, if I need 20 liters of, let's say, a crude oil, okay, so there are two ways. I enter into an contract today itself for the delivery after 6 months, right? That was there in forward, and I cannot deny the delivery. After 6 months, whatever is the price, I have to accept it. Although I have locked the pricing with the supplier, right? But in reality, in market, whatever is the price is appearing, I will have to accept it. So in this case, the price is also defined as of today, but I will have a choice. So if, let's say, in market, if I get it on a cheaper rate, I will not exercise my option to buy. Under this, I will just go to the open market and buy. I hope you're able to make the difference. However, in forwards, that choice was not there. You will have to go to the forward seller and take the delivery from that forward seller. So, there is a specified price which is called as a strike price, or sometimes we also call it as exercise price, because at which this is the price at which the exercising of the options will happen. Okay, then when it will happen? So students, you would recall we discussed some of the basic characteristics of derivatives, in that the one of the condition was it is limited, right? There is a limited time period. There is a time period to expire. So even let's say forward and futures we discussed, they were 6 months, 3 months, 2 months kind of expiry. So the same kind of expiry is here in the call option as well. So which is at an agreed date or up to an agreed date. So that right to exercise in case of European option is on a specific particular date. For example, there is a right to buy X Limited's equity share at the price of 100 rupees, okay, on 28th of February. That is called as European option because you only have a right only on 28th of February when you when you can decide. So at an agreed date means only on a single date. Similarly, there is a right to buy X Limited's equity share at rupees 100 up to 28th of February. Both these statements are different, right? So the up to an agreed date will qualify this as an American option, students. And the overall terms and conditions will be very much different because now if the option is favorable on 20th of February, we will exercise that, correct? The holder will exercise that. But if the option is not feasible or not favorable on 20th, but it becomes favorable, let's say on 28th, then also you can exercise the option. So in a way, American option will give a better, I would say, a better choice, a choice window to the option holder. Okay, now this we will come to the parties to these options later on. Okay, we will come to the parties of this option. As of now, we are trying to understand that what is that instrument or what is that contract itself called or what is that option itself called. Okay, so we need to call this as a call option, students, because it's a right to buy. Call means what? I can call it back. You know, callable shares, puttable shares, right? So callable shares means that the company has a right to call it back. Similarly, similarly, in this call option, there is a right with the holder to buy the underlying. Clear? I will take a quick pause and see if there are any questions around this or any thoughts. Okay. So students, I would suggest wherever you are feeling any gap or you want anything to be repeated or any clarification, any doubt, please do definitely let me know because this is really, really interesting as well as important topic. Okay. So with this, we discussed about the call option. Now let's see what is the right. So A is a right to buy X Limited's equity share. So in this case, I am assuming the underlying asset to be X Limited. Now, students, what all we discussed in our last session, what all things can be an underlying? Come on. What all things can be an underlying? Please do post in the chat or please call out whichever way you want to say. Yes, very good, Jyoti. Okay. So that is one and the same thing, Jyoti. Yes, very good. Currency, commodity. So in case I would want to say, yes, Lavanya, you're right. Shares, commodity, interest rates, forex. Very good. Samminathan, very good. Equity, exchange rate, commodity, weather as well. Yes. Jyoti, shares, bonds. Yes. Sensex, Nifty. Very good. Very good. Awesome. So I hope if you imagine all these underlines into this statement rather than X Limited's equity share, you will still get the same result. Now, what if I substitute a Sensex here? Or let's say if I substitute, okay, let me substitute a commodity here. For example, Oil again, or for example, metal. So A is a right to buy gold. Okay. For example, metal is gold priced at, let's say, whatever is the price on or up to, that will depend on the European or American option. So you can imagine it can be anything and everything. Okay. So this will be on, okay, on 90th day from today. So this is called as European option. Then A is a right to buy X Limited's equity share. Again, the same example, priced at 100 per share up to 90th day from today. Any day up to 90th day, the exercising can happen. And this is really, really important, right? Okay, so now let's come to what can be the different outcomes. For a moment, for simplicity, let's assume that we are talking about an European option. We are standing on 24th of September, let's assume, and 10th of October is when the option is going to be exercised, right? That's the expiry date of that option. So the right to buy at the rate of 100 on 10th of October, that is what the option says. Now, what are the different possibilities, students? The possibilities are, there is an actual price of 120, okay, against 100 rupees of the exercise price. That's the first possibility. Or on 10th of October, the second possibility can be, it can be 90 rupees as well. The prices are fluctuating, right? It can be on a higher side, it can be on a lower side. So in case it is on a higher side, now see how we will think. The person who is holding this, right? So now let's see, let's frame the statement. So in case you are getting confused, if it is higher, then what will happen? Lower, what will happen? Call option, what will happen? Put option, will what will happen? I'm just giving you a very simple lines to be framed within your mind, and you will get the answer. I have a right to buy. Okay, I means let's assume I am having the call option. I am having a right to buy at the rate of 100, but in the open market, I can get the same thing at 120. So should I go to the open market or should I buy through this options? I will buy through this options because that will be a cheaper thing. So I will exercise my right to buy under the option, and I will not go in the open market. Very good, Jyoti. Yes, through the option. Saminathan, yes, through option. Correct. So always think it from, always compare it. If I am in a buying position and if the prices actually are higher, I will definitely go and exercise the option. Now, case number two, students. If the actual prices become 90, it can happen. Then what will be the statement? I have a right to buy. I have a right to buy at the rate of 100 rupees, but in the open market, the price is also 90 rupees. So what I will do, I will go to the open market and purchase in the open market. I will not exercise my right here. Hence, first of all, it's not a right anymore, right? Because something, if it is available in the market at 90 and you have a right to buy at 100, it's not a right, right? Because right is something where you have some kind of benefit. In this case, there is no right attached to it, and hence you can go and buy in the open market. Clear? So, this is the very premise of any of the discussions whenever we talk about the settlement of options, students. Okay. Now, this is one. Second thing, what I want to bring in here. Now, tell me, what if this instead of an option was a forward contract or was a futures contract? Then what would have happened, students? Then what would have happened in case this is a forward contract? So 120, still the forward contract would have been exercised and the purchase would happen at 100. Let's assume the forward rate was agreed as 100. Okay, let's assume the forward rate was agreed as 100. So, in case the market price is 120, still the forward agreement would have been exercised. But if what if the 90 rupees is the actual price and forward rate is 100 to buy, still do you think the person needs to exercise the forward rate? What do you suggest? Okay, yes, very good Lavanya, very good Saminathan. Yes, yes, there will be loss. So, yes, first of all, it has to be exercised because this is a forward. There is no option here. It's a mandate, it's an obligation. Now, here, if you see, the right becomes an obligation in case of a forward, right? So, so it's not an option, and hence it needs to be exercised at 100. There will be a loss of this 10 rupees. Correct, because in the market it would have been available at 90 rupees, but now it has to be purchased at 100 rupees. Clear? Okay, we will come to this insurance companies later on, the discussion to it. Let's first cover the put options as well. Now, if call option is clear, students, let's move to the second type of the option as put option. Put means what? Put means to give, or let's say to sell. So it's again, let's name this as B, because A we have named as cap option. So let's name this as B. So B is a right, is an option, right? Again, the same thing, but it's not an obligation, but not a mandate. So again, it reflects that power with the hands of holder, whether he or she wants to exercise or not to exercise. Okay. So what it is, the right to sell, the right to sell. What was there in call option here? The right to, sorry, the right to buy. Yes, call was having the right to buy. Here, the put option is having the right to sell. What? Again, an underlying asset. An underlying asset, which will be specified within the contract at a specified price, at an agreed date, or up to an agreed date. So this is again European or American option. So either it will be at a particular date or up to a particular date. Clear? So now students, tell me, what is the real difference between a call option or a put option? The call option or a put option, there is only one difference. Call option gives you a right to buy, and put option gives you a right to sell. Okay. The right to sell what? The right to sell the underlying, students. Clear? Now, let's assume the same thing over here. There is a right to sell at the rate of 100 on 10th of October. So that means this needs to be exercised on 10th of October. First of all, we're talking about European options. Okay, always be clear in mind whether this is an European option or an American option. This is an European option. So European option is a right to sell, which is a put option. Now let's see what are the different possibilities. Now on that particular date, let's say there is a 80 rupees. On the date of exercise, the actual price becomes 80 rupees. Then what will happen? Now let's say I have a right to buy X Limited's equity share at the rate of 100. The open market rate is 80. So what will I do? I have a right to sell. I will always sell at the higher price. So 100 rupees is the price under the contract, under the option. So I will exercise the right. Okay, I will do the rights being exercised. Yes, Lavanya, you're right. We will be exercising the right. Very simple. Now, case number two, students. Let's say the price has become 120, which is a higher than the strike price. So, do remember this is a strike price. Strike price. Correct? So, the strike price is lower than the actual price in the case number two, because let's say the actual price is more. So, in that case, what will happen? I have a right to sell at the rate of 100, for which the open market rate is 120. So, what should I do then? I will say that it's not a right anymore, because I will go in the open market and sell in the open market. So it's not a right anymore. We will just go and sell in the open market. Again, it's yes. So we will come to Saminathan in the option, out of the option, right? Those discussions as well. So as of now, it's not a right anymore. I will not exercise through this option. I will just go outside and sell it outside. Simple, easy and clear. Now let's come to the parties to the option. Any doubts, students, till now? Please do let me know. This is how the option basic concepts are this, right? We will now keep on adding some of the things. For example, we will be keep on adding the parties to the option. We will keep on adding the valuations, right? How will be the valuation working? We will keep on adding some of the advanced things to the options, right? Now, the parties to the options. This is a very, very important thing, and very, I would say, a thing to be noted, which will make a lot of difference. Okay. Now, how? First of all, tell me, right to buy is what? It's a call or it's a put? Call. Very good. Thanks, everyone. Lavanya, Saminathan, Jyoti, thanks for answering that. So, it's a call. Now, tell me one thing. The As we discussed that there is a party to the derivative also, which will be different from the party who is the actual seller and buyer of the underlying. Remember, from our previous sessions discussion, I mentioned that derivatives, in the characteristics of derivatives, it's a important characteristic where we say that the parties to the derivatives are different from the parties who are actually dealing in the underlying. Correct? Because let's say the underlying is getting dealt in a stock exchange. Let's say X Limited's equity share is getting bought and sold between A and B, but there is an option on those equity shares that is getting traded in the F&O market, futures and options market, right? F&O segment. Now, within that F&O segment, the buyer and seller of the option will not be A and B, they will be C or D. You're getting my point? So they will be different. Now, with this understanding, even to this call option, there will be a separate buyer, there will be a separate seller. So the buyer is called as holder. Here, the seller is called as writer. So someone will sell the right, someone will purchase the right. So you're able to get it. What we are talking about here in terms of the purchase or sale is the right itself, not anything else. We are not talking about the underlying share itself. We are only talking about the right itself. So there is a buyer of the right, there is a seller of the right. The buyer of the right is called as the holder of the right. The seller of the right is also called as the writer of the right. You can imagine there is an insurance company. Okay, what does insurance company does? There is a policy holder, right? The one who has taken the insurance is called as the policy holder. The company who is giving the insurance Is the insurance company, we say that they are writing the risk, correct? They are underwriting the risk. Remember? So these are all the terminologies that we use. So writer means that they are actually undertaking the risk. Risk of what? Now, if some loss happens tomorrow to the policy holder, that loss will be fulfilled by that person, by the insurance companies. Okay, so in a way, if you see, the options are also very similar to the insurance contracts, right? Why? Because the there is a indemnity, there is a protection against the opposite movement of the share prices, that is guaranteed to the option holder by the option writer. Okay. Now, there is a question from Saminathan. Sir, what is the underlying in the option versus future? Is there any difference in the underlying? The answer is no. The underlying can be similar. Like we discussed, it can be equity shares, it can be any commodity, it can be a foreign exchange, okay, it can be a interest rate also. So the underlying between future and option can be similar. I mean, the nature is similar. Okay. So we were discussing that just like insurance contracts behaves, the similar parties are there for the options. Now, as I was saying, students, here, this is a call option, right? Yeah. In call option, we said that 120 rupees the option will be exercised. What is happening at 120 rupees, students? Tell me. Is there is a loss to the, okay, for one side, don't imagine that there was a contract because for the call option. Okay, just imagine that in the open market 120 rupees has been the actual price, but the expectation was 100. So can I say there was a loss, there is a loss to the holder in this case? If the price is 120, the answer is yes, there is a loss. Now this loss is made good by the option writer, the option seller who has sold this option. That person will undertake to make this loss good, and hence we concluded that this option will be exercised and there will be a right to buy, students. Clear? So there is a right to buy and hence it will get exercised, and there will be a insurance kind of a mechanism that will work over here. Clear? Similarly, for put option, if the price is 80, the loss would be 100 minus 80, which is 20 rupees. So that 20 rupees will be borne by the option writer, and that option writer will give 20 rupees net payoff to option holder. Clear? And again, I'm saying this is to be not to be confused with the buyer of the underlying. Always, students, please remember, buyer of the underlying, seller of the underlying are separate. Okay, so this options contract is not settled at a gross level. I mean, the actual delivery of shares will not happen and actual outflow of the funds will not happen. It will only be settled through the net payoffs that we just now discussed, right? Yes, Jyoti, you're right. 20 rupees net payoff gain would have happened. Yeah. Yes, Aminathan, only net payoff. The seller, again, not to be confused with the seller of the underlying, students. Okay. So this is for the purposes of call or put. Now, what will happen on expiration? On expiration slash termination, the buyer or the holder of the right becomes the buyer of the underlying. So that person enters into the shoes of the buyer of the underlying. And here, the seller of the right enters into the shoes of the seller of the underlying. Correct? So they will assume the positions of these. However, whether they want to actually sell or buy will depend whether they want to settle it on a gross basis or they want to settle it on a net basis. But for options contract, always it will be settled on a net basis, students. Clear? Any questions? Any doubts, students, till now? Perfect. Now let's move ahead. Now let's talk about right to sell, students. Right to sell is what? Put option. Correct? Now within this put option, again there is a holder, there is a writer. The holder is who? The buyer of the right. What is the right here? The right to sell. Correct? So please do remember here the right itself changes, but the buyer of the right is still called as a holder. Okay? Here the right is to sell, but the buyer of that right is holder, and the seller of that right to sell is the writer, or who's the seller. And the on settlement slash expiry, because there is a right to sell, the holder is holding the right to sell, so that person will enter into the shoes of the seller of the underlying as the seller of the underlying, right? So the position will be very much similar to that of a seller of the underlying, because here there is a right to sell. Similarly here, the person will enter as into the shoes of the buyer of the underlying. Okay. Sorry. So I hope students you have noted here what I'm trying to say. The seller of the right. So basically, if I'm selling the right to sell, that means tomorrow, if the other person asks or wants me to execute the right, I will have to execute the right to sell that is there with that other person. That means I will have to purchase, because if that right to sell is with the other person, that person will be selling it to me. So I will become buyer of the underlying. Okay, my position will become similar to that of the buyer of the underlying. So, so you see, I mean, in terms of the concept building, this is something that is really, really important to know, that in terms of whenever we talk about an option, so the holder is one who is holding the right, whether it is a right to buy or right to sell. The writer is the one which is the person who is selling the right, whether it is a right to sell or a right to buy. But their ultimate positions of the underlying seller or buyer will actually depend upon whether it is a call option or a put option. Okay. I hope discussion till now is clear, students. Please do let me know. Okay, perfect. Then, perfect. Then let's come to, okay, so this is something that we have discussed, that Mr. A, if it is a holder, and Miss B, if she's a writer. Okay, so there is a holder and there is a writer. Okay, and both of them have agreed that Miss B will sell the right to buy or the right to sell, whatever is the case may be. Here there is a call option, here there is a put option. So there is a right to buy or a right to sell to Mr. A, and Mr. A will pay premium to Miss B. Because just like in insurance companies, there is a premium paid, right, to the writer. So the similar sort of a premium will be paid to Miss B for undertaking the risk. And this premium is not refundable or non adjustable. It is not that this premium will be adjusted against the payoffs later on, or this premium will be adjusted later on. It's not the case. Okay. Clear? So there is a premium involved, and the premium is the price of the contract, right? The premium itself is called as the price of the contract or price of the option, right? Yes, that's a good question, Saminathan. Margin paid in futures are refunded, but here in option, the premium paid is not refunded. Yes. And the reason is because in futures, you pay margin to stock exchange, which is an intermediary which will help you to execute the transaction. And it is held by the stock exchange as a deposit money, not as an expense, right? For futures. So tomorrow, if there is an adverse movement, they will adjust the balances from the margin money. But options, students, you pay premium to the seller of the option. Okay, it directly goes to the seller of the option, and hence that premium is a not refundable cost which will be taken into the income of the seller and expense of the option holder. Clear? Perfect. Now let's come to this example, students. Okay. Yeah. Now there is, let's say, a strike price, a spot price. Strike price is, let's say, 110, at which the option will get exercised. A spot price of 100, right? Tenure is 3 months, and we're talking about European option here against the spot price. X Limited's equity share is the underlying that we're talking about, and the premium is rupees 10. So the call option is a right to buy X Limited's equity share after 3 months at the rate of 110 per share. That's the call option. Strike price is 110, right? So Mr. A, who is the holder, the premium is already agreed as 10, right? So the premium to be paid is rupees 10, which is cost of giving the right, correct? So Mr. A will say, okay, since I have acquired a right, so for acquiring that right, I have paid a cost which is 10 rupees, correct? Which I will pay to Miss B, who is the writer of the or the seller of the option, right? Now, if you see, there can be different scenarios of spot price after 3 months. So this is after 3 months. Okay. Please do remember, students, strike price is 110. Now, if actually the price is 125, students, if the price is 125, yeah, if the price is 125, then tell me whether the option will be exercised or not. Yes, Jyoti, you're right. Lavanya, you're right. I request all of you to answer. We are talking about which option here, students? The call option. Call option, actual spot price is 125 against the strike price of 110. The option will be, okay, Saminathan, you need to check once. Okay, let me explain it. So if the exercise price is 110, market price is 125. Now let's say how we will read this. Yes, will be exercised. Okay, very good, Saminathan. But I am again, just for the sake of repeating, I have a right to buy X Limited's equity share at 110, but their open market rate is 125. So I will not go in the open market and purchase it. I will exercise the right to buy at 110, and hence the option becomes exercisable, right? So at 125, it's a favorable to Mr. A, and it is called as in the money, students. In the money means that the option will be giving the money to the holder. So basically, in the money means that the option is having the value attached to it, which is the difference between 125 and 110. Then, if the price is 95, which is a lower than exercise price, so it's not a right anymore because I can just go in the open market and purchase X limited at 95 rather than at 110. So here it becomes out of the money because the option is not giving you any money, right? Any benefit is not being given to you, and hence it becomes out of the money, students, right? If it is 110, then holder is neutral. It becomes either add the money, right? Then it becomes neutral. Holder is neutral. Clear? So here it is exercised, not exercised. It can be not applicable for 110 price. Now, if students, we talk about gross settlement, okay? Now let's also talk about the both the kinds of settlement. If there is a gross settlement, then what will happen? At 125 rate, Mr. A will pay to Miss B 110 rupees because that's the exercise price and receive one share. Simple. But if it is 95, then in terms of the gross settlement, nothing will happen. Nothing will happen in between Mr. A and Miss B. Clear? If it is 110, again nothing will happen because the transactions are settled. The transactions are settled outside this option. Okay. Okay. So Jyoti, the 15 rupees or 0 rupees is a net settlement, right? But in case we're talking about the gross settlement, so the entire 110 will be paid and one share will be received. Okay. Perfect. Now let's talk about the net settlement. Now, as you rightly said, Jyoti, it is will be 15 rupees. So, so the second way of executing this contract is that 125 minus 110, which is 15 rupees, they will receive 15 rupees. They will receive, okay, and they will just go in the open market, purchase it at 125. 15 rupees they have already received, so their overall cost becomes 110. I am talking about in the net settlement of the first scenario. Clear? Similarly, if the price is 95 or 110, now tell me, students, what will happen here? What is the net payoff that will happen at 95? Let's say that first. Yes, very good, Samyanathan. If the price is 95, what would be my net settlement, students? It should be 110 minus 95, which is 15 rupees. It should be 15 rupees. Is it right what I've mentioned here, students? Yes, Jyoti, you are right. Yes, it cannot be this because we're talking about option. Had this been forward or future, we would have mentioned this as minus 15 because 15 would have been required to be paid, not received. Okay. So this is basically at 95, nothing will be exercised, and hence whatever premium we have paid above, that becomes the loss. Yes, Jyoti, you are correct. Okay, if the price is 110, again the same scenario, nothing will happen in terms of the net settlement. So clear, in case we want to settle net, in case we want to settle gross, both the things we have actually discussed here. Okay, any doubts? Lavanya is saying, since holder of an option and holder of the underlying are different person, in case of the gross settlement, option holder should also have a share to make actual delivery. Yes, very good point, Lavanya. That's what we were discussing, right? That generally and practically, the options are traded in the futures and option segment, which is a stock exchange driven segment, and the net settlement is happening over there. But in case, let's say, I enter into an options contract for physical deliveries outside the stock exchange, in that case, the other person should have the shares to make a delivery. That we agree with you. Yes. Okay. Then, this is something that we already discussed, right? On inception, there is a 10 rupees premium that we have paid, right? So, net gain or loss, 15 rupees is what we have received, 10 rupees we have paid, so 5 rupees is the net gain. Here, 10 rupees is the net loss. Clear? And from B's perspective, if you see, this was from A's perspective. Now the net settlement from B's perspective will be just reverse, right? What they are receiving and what they are paying actually. So there is a loss of 5 rupees here. There is a gain of 10 rupees here. Correct. So if you see, the premium in the second and the third case becomes the entire income of B. However, in the first case, since there is a payout that has happened, so it becomes a loss. Okay, after the net off. I think this is what we have discussed above, right? So 10 rupees will be taken into the receipt of premium, and 15 rupees will be paid in terms of the payment on an exercise of the option. So can we now conclude one thing, students? One, let's talk about the loss to the writer. So in any commercial transaction or in any transaction, students, one person's loss is another person's income, right? Or other person's gain is the other person's loss. So I'm saying between A and B, if A loses, B gains. If B loses, A gains, right? That's the only equation that we can think of. So the loss to the writer will actually become gain to the holder, and gain to the writer will become loss to the holder. So this will happen. Okay, now tell me, the first case here which I mentioned here, the loss to the writer and the gain to the holder, will happen when? It will happen when the spot price is greater than exercise price plus premium. Correct? In case of a call option we are talking here. In case we talk about call option, if your spot price becomes higher than your exercise price plus premium, then there will be a loss to the writer and a gain to the holder. Do you agree with me? Yes or no, students? Right? And the second piece where there will be a gain to the writer or loss to the holder will be till the time spot price is less than or equal to, just a second. Yeah, so spot price is less than or equal to exercise price plus premium. Correct? So that will be the case where the second bullet will be triggered here, this one. Now let's come to the first one, the loss to the writer and the gain to the holder. First of all, the loss to the writer can be unlimited. The answer is yes. It can be unlimited because there is no exposure to it. I mean, there is no limit to the exposure, right? It can go into multiples. Similarly, the gain to the holder as a result of this can also be higher, right? It can also be unlimited. The second piece, which is gain to the writer, it will be limited only to the extent of premium, and even the loss to the holder will also be limited to the extent of the premium, students. Clear? I hope this is clear. So the point is that limited or unlimited will depend. So you can just think of from the insurance companies and the insurance policy holders again, right? So the insurance companies can go to bearing unlimited losses. By unlimited means that there is no limit to their exposure, right? However, the insurance policy holders will only lose to the extent of the premium that they have paid for purchasing the policy, right? So it is only to that extent, students. Clear? So this is all about the options discussions. Okay. Yes. So now let's come to one of the example of put options as well, students. Okay. Any questions? Okay. So put option, students, again we will say that there is a strike price of 110, the spot price is 100. Just the only fact that has got changed here is that it's an right to sell. Time period is 3 months, European option, and we are talking about X Limited's equity share. So there are two, Mr. A and Ms. B, again the holder and the writer. So on expiry, there are three different prices: 95, 110, and this one is 125. Now at 110, let's say A, B, and C. Students, I want you to answer in case of A whether the option will be exercised or not. If yes, then what is going to be my payoff on expiry? Ignore premium as of now. Just let me know what is going to be the payoff on expiry. So the first one is yes, Lavanya, you're right. Jyoti, you're also right. So here the strike price is 110. So Saminathan, as of now, let's ignore the premium. What will be my gain for A part? Okay, so I think Lavanya, Jyoti, you are right. Saminathan, yes. We will have to, yes, it will be 15. So the right answer here is 110 minus 95 is the 15 rupees is going to be the gain here. Correct? To option holder. In case the price is 110, the B part, whether it will be exercised or not, students, come on. Yes, you're right. It will not be exercised. So the answer is no. Yes, very good. Sachi, Jyoti, Saminathan, Lavanya, very good. So all of you are saying no. And the last part, C part, also will be no. Because the price is higher than the strike price. So it's not a right anymore. In case we want to say it's not a right anymore. Why? Because the the market price itself is higher, which can be used to sell the underlying, right? So the open market price is higher. Clear? I'm just checking. Okay, perfect. So again, by nomenclature, it becomes in the money, it becomes at the money. Okay, now this is the term. At the money means that no gain, no loss, and out of the money means that it is out of the money. Okay, now let's talk about the holder for call option. What is the conclusion here? Better if the spot price goes up slash beyond the strike price, students. This is really, really important, that till the time spot price is higher than the strike price, the call option holder will always be gaining. Similarly, on put option, it will be better if the spot price goes down below the strike price. Although, if I am into the selling position, this is not the ideal situation to be in. But because you have taken a put option, you will benefit from that put option if your price goes down. Otherwise, whatever premium you have paid will go for a sunk cost. Okay. Then these are the differences or comparisons between the options and futures. Option students have underlying assets, which again futures also have. The similar nature of underlying assets exists between options and futures both. There is a time limit to expiry for both options and futures. And for options, it's a right, not a mandate. Right of what? That holder only will gain. Because of that right, the holder will only gain. But because of futures, it's a mandate. Whether positive side, negative side, whatever movement happens, you will have to execute it. There can be a possibility of a gain or a loss, both. Right? We're talking to the holder. So here, this is from the point of view of holder. Okay. There is a concept of strike price, there is a concept of future price. So in both the cases, if whatever is the strike price is the agreed price, the deal will happen on that. Whatever is the future price is the agreed price, the deal will happen on that. Options have additional things in the form of premium. Futures and forwards is never anything on premium because there is no risk being undertaken by anyone. Okay. I'm saying the seller is not selling the risk, the buyer is not buying the risk, they are just selling or buying the regular transactions. Okay. Clear, students? So, this is what the difference between futures and options is. Okay. Now, let's discuss their payoffs. Let's discuss the options related payoffs. If there is a strike price of 40 and a premium of rupees 5, right? This is what we are discussing. Then there is a call option on that, and this is from the perspective of the buyer holder. And one more thing we are introducing now, they are called they are called as having long position, or we can also call it as a long call. Long call means they are into the buying position of the call option, students. Okay, they are into the buying position of the call option. Clear? So that is called as long position in call option or long call. So how will their payoff look like? So on the y-axis, we are putting the payoffs. The payoffs means on expiry, just now we calculated, right? 1500. in both the examples for call option and put option just above. So that is called as payoff, right? And the price of the share is mentioned on the x-axis. So in case of a call option for holder perspective, the gain will increase as we said here, right? Better if the spot price goes up and beyond the strike price. So the gain will keep on increasing as the prices goes up. So what are we saying here? Yes, since the prices are going to go up, we are gaining. We are gaining. And the at the level of strike price here, which is what? 40 rupees and 5 rupees of premium. Correct? So 45 rupees is the price at which there will be no gain, no loss, right? The payoff will be zero. So here, if you see here, there is no gain, no loss. Hence, from here, the gain starts to come in as payoff. Clear, students? So there is a payoff on y-axis. There is a price of shares on x-axis. Using that, we can arrive at the payoffs. And this is the payoff chart. So till here, there is a loss. Then slowly, gradually, the loss becomes zero. And then slowly, gradually, it comes into the gain. More the price will be, more the payoff will be, right? So it is depicting that. Clear? Then let's talk about the payoff chart from the perspective of call seller, right? The above one was called buyer. Now this is also called as short call. Short call means that they are selling the call option and hence they are realizing the premium. So whosoever is selling the call option or the call option seller, the writer of the call will realize the premium. So in this case, the premium is 5 rupees, strike price is 40 rupees, right? Same example. But from the point of view of call option seller, as we discussed, right, the loss will be unlimited, but the gain is limited. Even here, if you see, the gain will be unlimited. Correct? But here, if you see the next one, the call option seller, the gain is limited up to 5 rupees. Why gain is limited? Because the premium is the maximum amount. At whatever price may be, the maximum amount that can be earned is premium. Now, if the price goes beyond 45, then there is a payoff that needs to be paid by the call seller, right? And hence, that will reduce, or let's say that will have an impact on the payoffs that they are paying students. Clear? Any questions till now? In the payoff chart, in the payoff graph, but it's relatively easier and simpler. So we have been kind of discussing about the similar things, right? Just to be very sure on the concepts. Okay, perfect. Now let's move to put option, students. Okay, so the put option is a right to sell. Now we will be talking about from the point of view of the holder or the one who is the put buyer longing the put. The strike price is 40, the premium is 5. So in this case, students, in this case, what will happen? The put option will be in the money, or it will help the payoffs to call to put option holder if the price goes below, right? If the price goes low, then it will be beneficial to the holder. So in this case, first of all, the graph will be looking like this, right? Which will mean that till the time the prices are higher, up to a certain point, if they fall, there will be a limited loss to the extent of premium to the put option holder. But if the prices fall below for 35 here, right, below 35 here, which is 40 minus premium, 5 rupees of premium. So that is the line where the gain will start coming into the put option holder, students. Okay. Okay. Clear? Then let's talk about from the put option seller perspective. We also call them short put, right? That means you are selling the put option. Here we have also called them the long put. So wherever these terms are used, long, short, long means buying position, short means selling position. But here it's about the option, right? Not about the underlying. Long put means longing the put option. Okay. Now coming back. So here the loss will be unlimited, but the gain will be limited. Gain is limited, right? Why limited? Till the time prices are falling up to 35, there will be a gain, a limited gain of premium that the put option holder, put option buyer, put option seller have received. Okay. And if it goes down, then there is a payoff requirement that this put option writer needs to pay to the put option holder, and hence the losses will increase. So basically it's like this. So it can go on basically in terms of the losses, students. Clear? Then let's come to the next piece. Okay, so I think this is some discussion that we were having, that if you talk about a stock exchange, the way it functions is there is a buyer who will place a request, there is a seller who will place a request. Let's assume the buyer is placing the request at 100, seller is placing the request at 120, and if both of them agree, and through a bidding process, if they agree to a 110 rate, so the stock exchange will match their rates and get the deal executed at 110. Correct? So this is how the trading happens on stock exchange for spot market equity shares. Now, what about future, students? So in case of futures, there is a future price, right? There is a future price. So there is a buyer of that future, there is a seller of that future price, and they will deal on that future price on the stock exchange. What about options? So in case of options, the price at which they trade on a stock exchange is the premium. Okay, it's the premium being paid or received. So there is a buyer slash holder, there is a seller slash writer, right, of these options, who will pay the premium or receive the premium. So what if, okay, let me ask you, that buyer or the holder is quoting a premium of 10, seller or writer is quoting the premium of 12. Again, if they both of them agree through bidding process 11-11, it will happen. Okay. So what if there is a call option, premium initially was 10, right? Now it is increasing, right? The volumes and even the trade in this call option is increasing. So that means people are willing to buy the right to buy, correct? More. There is a higher demand and hence the prices are increasing. Similarly, if put option, there is a premium that is increasing. There also the people are willing to buy, right to sell more, correct? So premium basically indicates the pricing of the options, students. I hope this is clear. So similar thing, I think purchase call option at the rate 20 per premium, purchase put option at the rate 25 rupees per option, basically in terms of the premium. So this is what we have covered till now, students, about the options, the parties to the options, the basic concepts to the option, how the settlement will happen, even the gross settlement will happen, the net settlement will happen, how to look at the payoffs, how to look at their gains and losses of both the holders and the writers, right? And how the overall transaction is dealt with. What is their differences or comparisons with respect to the forwards or futures? Okay, so till now we have covered all this. Now let's come to the next part of how you can value an option. So there are different valuation techniques that are there that we will cover. Okay, but the value of the call option is what, students, or the value of the put option is what? Their premium. So in this case, we are trying to really determine that what is the premium to it. Okay. Now let's first talk about the binomial model. Binomial model. Bi means two, right? We say binary digit, right? Bi means two things, right? One is the upper, one is the lower. So there are two possibilities, one of prices going up, second of prices going down. So this is the premise which binomial model assumes, that there are always two possibilities. If let's say today we are standing on 0th day, after 30 days there are two possibilities, that the price can be this, the price can be that. Simple. Similarly, let's say we are standing today in the morning, and then maybe we can say 1 hour from now the prices will be this or the prices will be that. So we are not concerned with the timelines window here. It can be anything. But what I'm trying to say is that it always thrives on the concept that it can be only dual kind of outcomes, either that or this. Now, let's take an example. The rate of interest, let's assume to be 10% per annum. Okay. The strike price, let's assume to be 28. Okay. And the spot price today is 30, for example. Okay. Let's say there is a X Limited's equity share of this call option that we are talking about. Okay. And please do remember, we are talking about call option. Underlying can be X Limited's equity share. The strike price is 28. And today the spot price is 30. Time to expiry is 3 months. Okay. So time is 3 months. Clear? Now, what will happen after 3 months? So there are two different possibilities, students. The first one is the price will be higher, and the second one, the price will be lower. Now, how to calculate what will be the price here? So for calculating that, okay, so this additional piece of the information is already given to you, that the higher price can be 33 and the lower price can be 27. Okay, so this additional piece of information is already there. So if the price is 33, in terms of the call option, strike price is 28, students. Now tell me, this will be in the money or out of the money, students? Come on. This will be in the money or out of the money? We are talking about call option. The actual price is 33. Strike price is 28, students. Yes. Very good, Lavanya. Very good, Jyoti. Others also, please do respond. What is it? Whether it is in the money or out of the money? So it is in the money, students. And the extent to which it is in the money, yes, very good, Sachi. Its extent to which it is in the money is 5 rupees, which is 33 minus 28. This 5 rupees, it is in the money. And if the price moves down to 27, so 28 is the strike price, 27 is the spot price. Now tell me whether in this case, whether it is in the money or out of the money. We are talking about call option. So the call option will be what? Yes, very good, Lavanya. It will be out of the money. Yes, very good, Sachi. Yes, very good, Jyoti. Sambhinathan. Yes, all of you are correct. So it will be out of the money. And hence there will be zero payout. Okay. Now, since we know that if the price goes up, there will be a payout of 5 rupees. If the price goes down, there will be a payout of 0 under this option. We also need to calculate that what is the probability of price going up and what is the probability of price going down. Accordingly, we can calculate that what is the weighted average payoff that will happen towards the after the third month, and then accordingly we can calculate the premium. So there are two ways to calculate probability. Okay, the first method is the probability of prices going up is actually 1 plus r minus d divided by u minus d. Okay, so which is r is the rate of interest that you expect, right? The rate of return. D minus, so minus d is basically d is the proportion of the reduced price, which is 27 by 30. So zero point 0.9, the reduction has happened, and u is the proportion of increased price, which is 33 by 10, which is 1.1. So okay, and one more thing, if it is a continuous compounding case, if this is a continuous compounding case, then it will be e raised to the power rt, right, instead of 1 plus r. Clear? Because in case of continuous compounding, we always assume that the number of compoundings are infinite, right? Those are unlimited. So e raised to the power rt is what we use there. So r is the rate of interest for that relevant period. Now here 5%, 10% was for 12 months. So for 3 months, it will be 2.5%. Correct? So 10% divided by 12 into 3. Then let's compute the probability of prices going up using the this formula, probability of prices going up. It is calculated here 1 plus 2.5% minus 27 by 30. This is the proportion of prices going down divided by 33 by 30. This is the proportion of prices going up minus 27 by 30. This is the percentage or proportion of prices going down. So it becomes 62.5%. So this is the probability of price going up. Similarly, the probability of price going down is 37.5 students. Clear? Okay. Then let's come to the second way of calculating the probability, which is called as the risk neutral method. Okay, let's first cover how to calculate probabilities. Then we will go where are we using these probabilities. Okay, so the second part is the risk neutral method, wherein we say that let the probability of the price being 33 be p. Okay, which is, let's say we say that if the price is going to be 33, then the probability is p. That means the price going 27 will be 1 minus p, as we are saying that both p and 1 minus p are only two possibilities that can happen, right? Hence we are saying if p is the probability of happening first chance, so the 1 minus p will be the probability of happening second chance. So 30 is equal to 33 into P, right? So 33 is the higher price. At that, the P is the probability that it will go up, plus 27 is the price going down multiplied by the probability of that price going down, which is 1 minus p whole divided by 1 plus r. So what are we doing here? If we are dividing it 1 plus r, that means we are calculating the present value of expected price. So if you see only till here, okay, so this is what? This is expected price, and this is the present value of that expected price for the third month, and this is the actual price at 30. So 30 will be equal to 33p plus 27 minus 27p divided by 1 plus 2.5%, right? So it will be 30.75 minus 27 is equal to 6p. That's what we will solve for. So hence the overall p becomes 62.5. The probability of prices going up is 62.5 percentage. So 1 minus p is equal to 1 minus 62.5, which is 37.5 percentage, the probability going down. Okay. Clear, students? So the result is same. If you see from the way of calculating probability above, 62.5 was the probability and 37.5 was also the probability. So whether you do it through risk neutral method or whether we do it through this formula, it will give you the one and the same thing. And let me tell you, both of them are derived from one another, right? So the derivation of this formula is actually coming from risk neutral method only. Now, 62.5 is what we will substitute as the probabilities here and calculate the weighted average payout, right? Because both the possibilities have different probabilities, have different outcomes. So we will calculate 3.125 becomes the 62.5 percentage weighted average number, and this becomes 0. So the overall is 3.125, students. Okay. Now, if 3.125 is the weighted average payout, what is this, students? This is weighted average payoff after 3 months. Now, what we will have to do, we will have to take a present value of this to arrive at the premium as on today. So, let me tell you, students, one thing, that whatever is the benefit under that option, that itself will lead to the premium of the option. For example, if the payoff expected under an option is 10 rupees, the premium cannot be 15 rupees. The premium will always be up to 10 rupees, right? Because if I think I will get a benefit from that option only 10 rupees, why will I pay a premium of 15 rupees? Similarly, if you think from a writer's perspective, the call writer perspective, the call writer will say that if the payout will happen at 10 rupees, why should I accept any amount less than 10 rupees? Right? So, in a way, the premium is actually representing the in the money amount or the weighted average payoff after 3 months, so which is 3.125, but this 3.125 is the future value after 3 months. This has to be converted to the present value to arrive at the premium as on today. So value of the option, which is value of this call option, is actually present value of probability adjusted payoffs. Correct? This is what we did. 3.125 is the probability adjusted payoffs. This is actually probability. If you just go by the nomenclature, right? Probability adjusted. Adjusted means multiplied. We have multiplied the probability in the payoffs. That's what it means. So probability adjusted payoffs is 3.125 divided by 1 plus R%, which is 3.125 divided by 1 plus 2.5%, which is 3.0487 becomes the present value of the premium. So the premium will be quoted at 3.0487. This has helped us in calculating what is the overall value or the premium of that contract. Clear, students? I hope this is clear. Perfect. So, in a nutshell, students, what does this concept says? Binomial model. Binomial model says a very simple thing. It says that there are only two possibilities, either the price going up or down. If the prices goes up, then we will have to calculate the probabilities. If the prices goes down, then also we will have to calculate the probabilities. Now, how can we calculate the probabilities? There are two options. One, using this formula, which is possibility of price going up is equal to 1 plus R minus D divided by U minus D. Second is using the risk neutral method formula, which is this one. Both the formulas gives us the same result. Once we have the probabilities, then we calculate the payoffs at each nodes. Okay, so let me tell you, this is a binomial tree. This we call it as binomial tree, wherein we put the different nodes. So there are three nodes to it, or rather there are two nodes to it, 33 price and 27 price, right? After 3 months. So at each and every node, we have to calculate the payoff. After calculating the payoff, we have to multiply it with the respective probabilities to arrive at the overall weighted average payoffs, right? Once the weighted average payoffs is calculated, then we just take the present value of it to arrive at the premium. Yes, Lavanya. If 3.0487 is the present value that is coming out to be, that means it it is a gain to the writer which is restricted to 3.0487. That is true. Clear? Or I can say the loss is also limited to the option holder to the extent of 3.0487. Okay, students? Perfect. So I think this is it from binomial model. We will cover now the next model of valuation. Before that, let's take a quick break of 12-13 minutes. Let's again reconvene at 8:40, students. Let's move to the next part of our discussion. Let's move to, I think, Black-Scholes model, which is the next going to be. Okay, one more thing. Sorry, binomial model, one more thing. Now, if you see in this example, right, or in this question, there can be different nodes, right? So A is having two nodes, B and C, then B is further having D and E. And again, C is also having E and F, right? So there can be further nodes to these attached. And it is a two period binomial model, basically. That's what we say, okay? So even that is also possible. Yes. Now, yes, students, let's discuss about these four different cases. And then we will come to the Black-Scholes model and put-call parity theory today. Okay. So the first one is actually, yes. So the first case is if I long a call option, that means if I purchase a call option, that means it's a right to buy. That means what? I am agreeing to purchase the share at the strike price. So tomorrow, if I have to execute this, then I will have to get the strike price equivalent of money. So what I will do, I will invest the present value of strike price today. That's what I will do, right? In case the case 2 now is to short the call option. In case I have to short the call option, that means I am selling the right to buy. If I'm selling the right to buy and that right to buy gets executed, that means I have to sell the share, right, on the expiry, because it's a call option. If I'm a writer, I have to sell the share. So what I will have to do, I will have to purchase a share today itself, right? I will have to purchase a share today itself. Case number third, students, it's about long put option. Long put option means buying a put option, which is a right to sell. If I have to purchase a right to sell, that means tomorrow I have to sell. On expiry, I will have to sell. That means I will have to purchase a share today. So if you see, students, these cases are telling you if you are doing something in your options market, what parallel operations you will have to do either in the cash market or you will have to do some sort of investments. Clear? In this case, what is happening? You will have to purchase the share because you are purchasing the right to sell. Purchasing the right to sell means that tomorrow, if the right gets executed, then I will have to sell. Okay. Case number four, students, is once I short a put option. Once I short a put option, that means once I sell a put option, that means I'm selling the right to sell. That means tomorrow I might have to purchase the share, right, on the exercise. So what I will do, I will invest the present value of strike price today. I hope these are clear. These four cases are clear, students. Any doubts in this? So, I mean, there are four cases for both call option and put option, two cases each, buying and selling. If I buy call option, I will have to invest present value of strike price today, so that on expiry I get the strike price equivalent of amount and I pay to purchase the share. Similarly, for shorting the call option, if there is a right to buy getting executed, I need to purchase a share today so that I can sell that share to the person who is purchasing that option. Similarly, longing put option, there is a right to sell. For that, also purchase a share today. Case number 4, short put option, right to sell, invest present value of the strike price today. Okay, so these are the 4 different cases. Now, let's take the cases from this to understand the Black-Scholes model. And option premium is always reflective of the extent to which it is in the money adjusted for time value of money. Okay, so option premium is always reflective of the extent to which it is in the money. Again, remember, student, the same thing we discussed, right? If 10 rupees is going to be the payoffs, and this 10 rupees in the money, so option premium is always reflecting the extent to which it is in the money adjusted for time value of money. So if this 10 rupees is going to be paid after 3 months, so today's value can be 9.5 or 9.8. That will be the premium that will be quoted in the market as on today. Clear? Now with this understanding, let's move to Black-Scholes model. In this, we are making use of case 2, students. We discussed about 4 cases above, right? So from that, we are discussing about case number 2. Okay. The case number 2 was what? Wherein we are purchasing a share, right? And we are selling, writing the call option, right? Which is selling right to buy. Correct? That's what we were doing. So let's take from the angle of Mr. X. Mr. X is writing the call option. That means Mr. X is the writer, and which means that he's selling the right to buy. To whom? To the holder. Now, if he's selling the right to buy, tomorrow if right to buy gets executed by the holder, Mr. X will have to sell the share. For selling the share, then now we have to purchase and share and keep it with us so that tomorrow if we have to sell it under the option, we can sell it. So that means what? You will have to purchase the share and you will have to write a call option. These two things you will do, A and B. So I have mentioned it as event A and this is event B. Event A will mean that you will have to purchase the share today. Event B will mean that you are selling the right. You are selling the right to buy. That means you're writing a call option. If you purchase the share today, students, you will incur a cash outflow equivalent to the spot price today. Correct? And if you sell the call option, then what will you do? You will have a cash inflow to the equivalent of the strike price, which is, for example, 90 rupees in this case. Correct? So, what will happen? If you are selling the right to buy, so after expiry, once the right to buy is getting executed, you will get a 90 rupees, which is equivalent to the strike price, right? If you sell the share, you will get the strike price equivalent value. So, roughly 100 minus 90 should be the premium. Are you getting my point? Because 100 rupees is today's spot price, 90 rupees is the strike price after 3 months, for example. So, on a let's say rough calculation, 100 minus 90, 10 rupees should be the premium. So, can I say A minus B? So, the cash outflow in A minus expected cash inflow on B will be my premium. The answer is yes. But A is happening today, B is happening after 3 months. Correct? B will happen, the strike price you will receive after 3 months. Once you will get executed. So what will you do? So cash outflow is happening today, cash inflow is equal to the strike price. Let's do one thing. Let's first of all make, instead of B, the present value of B, students. So A minus present value of B is equal to premium. Let's do that first of all. Okay, we can do that. Then the premium is equal to, again we are rewriting it, A, which is the current spot price minus the present value of strike price, which is B. Then the premium of call option, the premium for call option is equal to spot price minus present value of strike price. Correct? This is what we can mention, the spot price minus present value of strike price. This is the premium. Here, students, we are assuming one more thing, that one share will be used for writing one call option, 1:1 ratio. This is also we are assuming to be otherwise. So this assumption is also wrong, because in reality there is a concept called hedge ratio. Okay, so the hedge ratio determines that how many shares in a spot market or in an underlying will be used to hedge completely your one forward or one future or one option. I mean, whatever we are talking about. In this case, we are talking about option. So for one option, how many shares in the underlying will be used? So that relationship is governed by hedge ratio. Okay. So hedge ratio will give us how many shares to be purchased so as to write one call option. You're getting my point? So can we say premium of call option is equal to spot price multiplied by hedge ratio minus present value of strike price? So the same formula, but just an introduction of hedge ratio, students, right? Spot price, because spot price is for one share, present value of strike price is against again one share. So to avoid the to avoid the basically 1:1 wrong assumption, we are always taking the hedge ratio here, students. Okay, so the spot price multiplied by hedge ratio minus present value of strike price. So the assumption that option is in the money. Okay, so this is, again we are taking a unclarified assumption here, is that this option is in the money, but always the option is not in the money. There can be chances that the option will out of the money also. Then in that case the premium should be zero, right? So let's try to introduce that as well, that aspect as well in the equation. So the next aspect is the premium of call option. After introducing this in the money assumption will be, I'm just rewriting the equation here, the spot price multiplied by hedge ratio, which is fine, minus present value of strike price. This we have already discussed above, right? Multiplied by, this is the new element now, which is probability that spot price on expiry is higher than strike price. So actually this covers what, students? This covers the piece that if the probability that the spot price on expiry is higher than the strike price, whatever is that probability, that is taken into account to calculate the premium. Had we not taken this into account, we would have made a mistake, because there can be chances that on expiry the spot price would be lower than the strike price. Clear? So these are the four factors, students, that governs your Black-Scholes model. Now if we rewrite it, now this is the formula given by Black-Scholes model. Now let's come to the formula. I've tried to explain you the derivation, or let's say the understanding behind this, why it is what it is, right? So premium is equal to spot price multiplied by ND1, which is the hedge ratio, minus E is the strike price into E raised to the power minus RT is the present value factor, right? So in totality, this is the present value of strike price and ND2 is the probability that we have discussed. So there are two different terminologies here, ND1 and ND2. We will elaborate them further. But as a formula, this is spot price multiplied by ND1, which is the hedge ratio, minus present value of strike price multiplied by ND2, which is the probability. Okay. Now, let's see. S is spot price, E is exercise price, ND1 is the normal distribution value for D1, ND2 is the normal distribution value for D2. Now, what is D1 and D2? Right? So, there are two things here. One, what is meant by normal distribution? Second, what is D1? What is D2? Right? So, first of all, students, what is D1? D1 is natural log of. So, this is basically natural log, right? So, the way we represent this as natural log is this. So, the natural log of spot price by expiry price plus R plus volatility square divided by 2 multiplied by T divided by V into under root T. Okay. So D2 is equal to D1 minus V under root T is what the D2 will be present. So what is V and T? We will cover that. But this is the formula of D1. So R here is the rate of interest, V is volatility, and T is again the time period. So these are the 3-4 factors that are here. R is equal to risk-free rate of return, T is time to expire, V volatility is the standard deviation of returns, S is spot price, E is exercise price. Clear? So then there is a natural log is equal to natural log reverse of E function. That's what we are trying to explain. Exponential function is E and natural log is just a reversal of E function. That's what it is. So both for natural log as well as for normal distribution, either the tables will be given to you or the relevant extracts from the table in the question itself will be given to you. I will explain you how. Now, students, what are we left with in this entire discussion? If I go step by step, I think all of us have understood here what how the premium is getting calculated. Now the next question is what is normal distribution? D1 and D2 is what we have already understood, right? So this is how the natural log is. For example, e raised to the power a is equal to b. So the natural log of b will be a. So that's how we call it as a reverse function. This is a reverse function. So the d1 is equal to natural log of s by e, right? Which will be higher. In case s is higher, so it will lead to d1 also to be higher. If d1 is higher, even the premium will also be higher. You're getting my point? So call option premium will be higher if the spot price is higher. This is what we are trying to say. If volatility is higher, then V will be higher, D1 will also be higher, premium will also be higher. So in this, what we are trying to say, if it is a highly volatile stock, the overall premium will also be higher. Okay. Then, now let's come to the normal distribution. Let's understand what is meant by normal distribution, students. So first of all, students, if you see any distribution, for what is meant by distribution? Distribution is just a collection of series of data. If I say you take X Limited and take the historical 10 years share price data, that is also a collection of data, distribution of data. Yes. Can I ask you to calculate the mean and standard deviation of that last 10 years of X Limited? The answer is yes, you can calculate that. It's simple, right? Mean is the average and standard deviation is the deviation of individual observations from those average. Correct? I'm not getting into the detailed formula as of now. So you can calculate the mean, you can calculate the standard deviation. Now, if the collection of data is having Yeah, sorry. Is there some question? Okay. So if the yeah, what I was saying is if the assume a distribution where mean is 0 and standard deviation is equal to 1. That is called as a standard normal distribution table. Reason being because standard normal distribution table has some characteristics. If you plot all the values on this axis, what is mentioned below for a standard normal distribution table, and you try to plot the different observations, you will found this bell sort of a curve. This is bell curve sort of a shape, right? And area under this curve represents the normal distribution value. Plus, the way this normal distribution works is it distributes the entire distribution into a symmetry. So if I just say, if I'm standing here, right? If I just draw a line like this, so 50% of the population will lie to the left side and 50% of the population will lie to the right side. That means it will distribute it equally. That is point number one. Point number two, area under the curve is always equal to 1. As this represents probability, so the probability always needs to be 1, right? So this area under the curve in totality represents 1. Now, if we have to convert any distribution to a standard normal distribution, what we need to do, we need to calculate a z score, the z score. This will be calculated how? You just first calculate the mean and take the standard deviation of that distribution, whatever is that coming. For calculating the z score, take that observation, reduce mean from that and divide by the standard deviation. You're getting my point? So if 18 is the normal number, 2.66 becomes the z score. And this 2.66 z score, we can easily calculate the value using the standard normal distribution table. Because 2.66 will tell us, okay, if it lies here, okay. So if I say 2.66 is somewhere here, so area from left to right will represent the cumulative values to it. Okay, so that is the Z score basically. And the 2.66 equivalent value from the normal distribution table will represent the overall area under the curve, which will be the probability or the outcome that we are looking at. Okay. There, there are some more properties of the standard normal distribution table. There is a standard distribution. Then if you add, so in that, if we add the mean, or if we reduce the mean, or if we take the standard deviation plus 2 times mean, here standard deviation plus 3 times mean, similarly here standard deviation minus 3 times mean, standard deviation minus 2 times mean. So this will actually represent the this will represent the standard intervals actually, if you ask me. And it's a property that almost 99.9%, let me tell you. So yeah, so between these two values, 99.7% observation will come under this value. Okay. Now let me just summarize this discussion of normal distribution tables. So students, normal distribution table helps you to answer that basis the historical trend, what is the probability that your next number will be the 18 number. For example, in this our case, we have said that 18, right? So what is the probability that the next number will be 18 number? It will try to tell you that basis the historical data. So the historical data, you will have to calculate mean and standard deviation, and then you will have to do this to arrive at z score, and then z score you apply to the normal distribution table to arrive at what is the percentage. So let's assume that percentage is 70%, students. Let's assume that percentage is 70%, okay? So 70% there are chances that 18 will be the next observation. That's what the overall story is. Clear? As I said that area under the curve represents probability. The total of area, entire area under the curve is equal to 1. So the Z score 2.66 becomes equivalent value of a table when the mean becomes 0 and standard deviation becomes 1. Correct? This is what we are saying. Mean is equal to 0, standard deviation is equal to 1. Okay, so if 18 represents the value of a distribution where mean is 10 and standard deviation is 3, 2.66 represents the value where mean is 0 and standard deviation is equal to 1. Clear? So 0.5 and zero point 0.5, as I said that if you just draw a line in between of the standard normal distribution, we will achieve 0.5 and zero point 0.5. So this is what it is. And yeah, I mean, for let's say 18th observation, if zero point 0.7 is the value, right? So that means up to 18, I mean, for 18th number to be there, 70% probability is there. If it is more than, I mean, what is the probability that the number will not be 18? That is 30%, right? So if 70% is here, so 30% will be not happening the observation basically. Clear? And always students remember we have to take area from the curve left to right. This is called as left to right. This is area under that curve. Okay. So this is called as one tail to cumulative, right? One tail to cumulative means that, so for example, this is one tail, correct? So for converting from one tail to cumulative, we have to just do 1 minus zero point 0.3. Okay. If it is given as two tail, sometimes the question will give you two tail. Then we will have to say 0.6 divided by 2 is equal to zero point 0.3. So 1 minus zero point 0.3 will become your cumulative. So what we have to use is always cumulative. Always use cumulative values. Always use cumulative values. So if it is given one tail, the question might confuse you. Don't get confused. Just take 1 minus one tail. That will become cumulative. If it is two tail, that means you just divide it by 2. That will become one tail. And then again 1 minus one tail, it will become cumulative. What is actually meant by one tail, two tail is what I have tried to explain here. One tail here means that it is from this towards the right. Okay. It's not the cumulative one. Cumulative will be always from left to right, students. Okay. Now, if you see this, I will just explain you this. So, number of standard deviation from mean is what? Z score, right? What was Z? Z is equal to A minus Mean divided by standard deviation. So number of standard deviation from mean. This is already given as Z score. So if 0.25 is the Z score, that means area of the left or right one tail is given as 0.4013. This we have to convert to cumulative, right? How can we convert it to cumulative? By doing 1 minus. So let's do quickly, students. Let's do see this question for Black-Scholes model so that we are able to tie it up our discussion on the valuation principle. So it is given to us. Price of the stock now 80. Exercise price is 75. Standard deviation of continuously compounded annual return is 0.4, which is volatility, right? Then maturity period is 6 months. This is time period. Annual rate of interest R is 12%, right? So these all information is given and one tail, two tail is given. We have to calculate the Black-Scholes model call option. Simple. Let's first write the formula, students. Value of the call option using Black-Scholes model is spot price multiplied by ND1 minus present value of strike price multiplied by ND2. Now here D1 represents natural log of S by X plus X here means the strike price, right? Plus bracket R plus volatility square by 2 into T divided by V into root T. That's the D1. And let's find out the natural log of 80 by 70. Correct? So the natural log of 80 by 70, which is actually given here. If you see 1.0667 is equal to 0.0646. That is the number that is given. So let's apply that. Simple. It was looking complicated, but it is just putting the values into the formula. That's all. So D1 will become 0.0646 plus 12% is the R plus zero point 0.4 was the volatility raised to the power 2 divided by 2 into 6 by 12 divided by this 0.4 into 6 by 12 under root. Why 6 by 12? Because time period is always 1. It is for 6 months, it will be 6 by 12. So D1 can be calculated as this one 0.5820. Okay, then D2 similarly will be D1 minus V under root T, which will be calculated as 0.2992. So we arrive at so we have to calculate now D1 and D2 for 0.5820, 0.2992, right? The cumulative one. So let's see what is given to us. We have been given 0.25 and 0.3. That means somewhere 0.2992 will reside in between these two, right? 0.25 and 0.30. So using interpolation technique, we can find out that what is the exact value, right? But before that, we have to convert this one tail to cumulative. So 0.4013, we will do 1 minus this, that will get converted to cumulative. Similarly, 0.3 will also get converted to cumulative, students, right? Then, similarly for these two. Now, 0.55 and 0.60, these values are cumulative values, but we have to find out value for 0.5820, this one. So this we can do using the interpolation technique, and the value will also lie in between these two, right? So this is the formula for interpolation technique. Again, we have been using this formula from the inter, and hence the value will be 0.7197 that we will get. So that means ND1, which is the hedge ratio, is 0.7197. That is the final answer. So that means for one call option, 0.7197 shares needs to be written. Okay. This is the interpolation technique that we have explained. 0.55, 0.60. If these are the respective values, 0.5820 will lie in between. Clear? Okay. Now, similarly for ND2 now, using the interpolation technique, again we can calculate. So 61.76 becomes the value. This is the probability that spot price on expiry will be higher than the strike price, that is 61.76% students. Then the value of call option is equal to spot price multiplied by ND1 minus present value of strike price multiplied by ND2. Right? This is the formula. So the spot price multiplied by hedge ratio will be ND1 minus 75 multiplied by present value of strike price, right? Which is the e raised to the power 0.12 into 6 by 12. So that's the present value factor multiplied by the ND2 value, which is 6176, 0.6176. Using this, we calculate the value of call option comes as 13.95 students. Very easy and very simple. Clear? So this is how the value of a call option is required to be calculated under Black-Scholes model. The formula is this, the explanation is this, right? Only thing is ND1, ND2 is the normal distribution value, D1 and D2 uses natural log. All these things will be given in the question. Always remember to use cumulative values, not one-tail values for normal distribution table, students. Okay. Now let's come to put option, which is the Black-Scholes model. So for put options, we have just now discussed the Black-Scholes model for call option. Now let's also discuss the put option, the Black-Scholes model for put option. Now here we are making use of case number 4, students. Right? For call option, we made use of case number 2 from the 4 cases we discussed, right? Here we are making use of case number 4. The case number 4 said selling put option. That means we are selling the right to sell. If we are selling the right to sell, that means tomorrow we might have to purchase the equity share, right? So what we will do? Two things we will do. One, there will be a cash outflow to the extent of strike price on expiry. Correct? On expiry, there will be a cash outflow to the extent of strike price, because if that option gets exercised, the right to sell get exercised, I will have to purchase that right at the value of strike price. Similarly, if the equity share needs to be sold as on today, that will help me in the cash inflow of spot price, right? Which I will invest. So what I'm going to do, I'm going to borrow one equity share. That's the step number 1. I will short sell that equity share. I will realize the funds, invest the present value of strike price today. Okay. Then on uh, on expiry, I will redeem the present value of strike price on maturity equivalent to the strike price. Then using that, I will purchase one equity share, which is through put option, and I will, after purchasing it, will hand it back to the person from whom I borrowed it. So this is just a cycle. Don't get confused here. It just tells you step by step what will happen. But the case number 4 remains intact, wherein the cash outflow will be to the extent of this and cash inflow will be to the extent of this. So what is the formula looks like now? So, okay, before that, today the option writer, which is Mr. A, and the option holder Miss B. Okay. So Mr. A is selling the right to sell and Miss B is purchasing the right to sell. So what will happen? Mr. A will become buyer after 3 months and Miss B will become seller after 3 months of the shares we are talking about, right? So Mr. A purchase the equity share, cash outflow of strike price that will happen. Miss B sell the equity share, receive cash equal to the strike price. Okay, simple. Then the formula here is value of put option is equal to, now here the present value of strike price is in the first part of the equation. This was in the second part of the equation in the call option, right? But in the put option, we will start with the present value of strike price multiplied by n minus d2. So if ND2 represents the probability that price will be higher than the strike price, N minus D2 will represent that the price will be lower than the strike price. Simple. And since we are talking about put option always have a higher value if the spot price goes lower than the strike price, right? So N minus D2 is this price probability that the prices will go down than the strike price. So this is N minus D2. Then the derivatives. Sorry, the S is the spot price here, right? Minus N minus D1 is the hedge ratio for a put option. Simple. So there it was N D1, here it is N minus D1. So the hedge ratio is this one. Why minus D1? Because there is an inverse relationship between the call option and the spot price. Simple. Okay. So it's just that the formula gets reversed, right? So the left part becomes the right becomes the left part, and both ND1 and ND2 becomes from N minus D1 and minus D2 perspective, students. Okay, perfect. So till now, students, what all things we have discussed? We have discussed about derivatives between forward, futures, and options. We have discussed about their concepts. We have discussed about how they are used in hedging. We have also discussed about their valuations for both futures and forwards and options. Now, how does their valuation differs? For futures and forwards, we talk about the compounding, which is actually the future value or the present value. For options, we have discussed all these things in terms of the valuation, which is binomial model, risk neutral method, and Black-Scholes model for valuing the call option and put option, students. Now comes the next part of put call parity theory, students. So put call parity theory, we will make use of case 1 and case 3, right? Let's take an example to understand this. What is this example? Now, there is a call option, there is a put option. Okay. Both of them have a strike price of 180. That is also fine. The spot price is 150. The value of call option and the value of put option is 15 and 10, which is their premium respectively. The rate of return is 20%, let's assume, and time period is 1 year. Okay. For the simplicity, we have taken rate of return to be 20% for 1 year itself. Time period is also 1 year. So if I say for case 3, what are the initial cash flows, and case 1, what are the initial cash flows? Let's call them as scenario A and scenario B, for example. Okay. So case 3, what was happening, students? Case 3, we were purchasing a put option and we were also purchasing a share today. So purchase a put option, we will end up paying 10 rupees as premium. Correct? So the 10 rupees was premium for put option, and for purchasing a share today, we will end up paying 150 rupees. So in totality, we will end up paying minus 160 as on today. Here, we are purchasing a call option, which is 15 rupees, right? And for purchasing a call option at the same time, we will have to invest the present value of strike price today. So 180 divided by 1.2, which is 150. That is what we will do. This 165 is what the initial cash outflow will look like. That is the premium of call option plus 150 rupees of the present value of the strike price. Now, their initial cash flows are a bit different, right? 160 and 165. Now, what will happen subsequently after 1 year? Let's take different scenarios there. Now, let's first take scenario A, students, right? Which is case number 3 as per our understanding. If price comes as 200 on expiry, then what will happen? Now, see, what about the option? First of all, the holder is having put option, they have purchased put option. Strike price was 180, market price is 200. So it will become out of the money, it will not be exercised. So put option is clear. So put option out of the money. Shares will be sold at 200. So plus 200 will be the value. And hence the net cash inflow after 1 year will be 200 in totality. That is point number one. Point number two will be for now investor two, the scenario B, which is case number one. Okay. So for this investor, call option was there, strike price 180, 200 market price, 20 rupees will be a gain. So 20 rupees in the money gain will be there. Plus investment was done at 150 at the rate of 1.2. So 180 will be getting as the investment proceeds on maturity. So there will be a net cash inflow after 1 year as 200 that we will be getting at an overall level. If the price comes down to 100, let's take is as the next scenario. For investor 1, the strike price was 180. The price has come down to 100. That means 80 rupees put option. There will be a benefit, students, right? There will be a payoff of 80 rupees. But shares will be sold at 100. So in totality, 180 will be the overall value. 180 will be the overall value. Now let's come to the investor two students who is having a call option at 180, market price is 100. It will be out of the money. It will there is nothing that will be paid. Okay. However, the strike price that is invested will be 180 here. So 115 to 1.2. So the net cash inflow after 1 year will become 180 here. Okay. So what we are saying is whatever price occurs in the market, realization of investor 1 is equal to realization of investor 2. How come? See, first of all, the initial value was minus 160 and minus 165. Subsequent value, in the first case, it was 200 and 200. In the second case, it was 180 and 180. So what is happening, students, here is whatever is the value, whatever is the value of the share price, their overall receipts is same. So that means their initial value should also be same. Correct? So what will happen here? By investing lower amount 160, you will still get the value what you will get after investing a higher amount. So what will happen? The demand of this portfolio will go down and the demand for this portfolio will go up, right? And it will adjust, the market forces will adjust these basis the demand such that both of them becomes equal at one point or the other. So minus 160 might say become 162 and this minus 165 will also become 162, so that it will become at an equilibrium because their future cash inflows are always going to be the same for both the different, I am saying investor 1 and investor 2. Okay. So the value of put option will increase and the value of call option will decrease simply because the value of put option was what? 10 and the value of call option was 15. So that 10 and 15, 5 rupees is the delta because of which the difference was coming. This 160 and 165, this 5 rupees is nothing but 10 and 15's difference. Okay. So that means always investor 1 will be as good as investor 2 in terms of their cash flows, whether we talk about now or whether we talk about on expiry. So the put call parity theory says that the put option value plus spot price, this is the portfolio of investor 1, right? Case number 3, as per our discussion, is always going to be equal to present value of strike price plus value of call option. This is case number 1. This is case number 3. Clear? This is case number 1. This is case number 3. So this is basically the overall story. And hence the put call parity theory says this thing only, that both of these portfolios, both of these values should always be equal. Now, where it is relevant, put call parity theory, put and call parity theory will be relevant when out of these four, any three variables will be given to you. One variable we have to identify. Okay. Let's say we have calculated value of call option, but we don't want to calculate value of put option again. So what we will do, we will just take this equation from value of call option, and using spot price and present value of strike price, we can arrive at the value of put option as well. Clear? So this is about the Black-Scholes model and put call parity theory, students. I hope things are clear to all of you. I will pause for a second in case you have any doubts or questions. Then probably we will come to the next part. Yes, I think there was one question from B. Kiran Kumar. For call option buyer, unlimited profit, call option seller, unlimited loss. Then how writers will emerge and how will they can face the unlimited loss. Correct. So that's what the question is. For example, as I said that, Kiran, for even for insurance companies, right? I mean, today, if there is some big loss that happens to the policyholder, the insurance companies will have to make good that loss. Correct. However, it is all, I mean, it is all about how you manage the risk. Correct. Which all places would you want to kind of write that option? So option writers are also smart. If basis their analysis, they know that in case of a call option, if the prices are going to go down, they will start going to sell the call options. They will start going to sell the call options, right? Because if price is going down, whatever premium they are making, that will be their income. Correct. So, I mean, it's a question of that how, what is their perception about the market going ahead. Perfect. Now let's come to the next part of our discussion, which is called as Greeks. Greeks are nothing but some of the factors that affects the premium of an option. Okay. These are the factors that affects the premium of the option. What are they? For example, there are four or five Greeks. Let's start with the first one, delta. Delta is also called as hedge ratio, that we have already discussed in our previous session and today's session as well. So what does it measures? It measures the change in the value of the call option divided by the change in the spot price. So if my spot price moves by 1 or 2 rupees up or down, what will be my change in the value of the call option? Similarly, change in the value of put option divided by the change in the spot price. Now, if spot price increases, the value of call option will also increase. It has a direct relationship. If the spot price decreases, the value of the call option will also decrease. Similar thing, if spot price increases, so the value of put option will decrease, students here. Reason being, because the put options will increase if the spot price decreases, as we have already discussed, right? This is the discussion on options. Now, extent of change is actually given by delta. Hedge ratio, ND1 is positive and minus N minus D1 was negative, right? You would be able to recall in put option, Black-Scholes model, this was used. Okay. So we were discussing about this. These are the call option buyer. We said that it is out of the money, then it is at the money, then it is in the money. So what we are going to say, delta is 0 when option is starting from deeply out of the money and slightly increase from 0 to 1, while the option moves from deep out of the money to deep in the money. So here what we are trying to say is that the delta is 1 here and 0 here. Simple. Okay. Then Basically, there is another point. Delta is also called as slope of the payoff line. So slopes. So in line system, you would have discussed about the slopes, right? This is back in 12th, 11th, 12th. So slope is basically delta, which is equal to 1, and here slope will be 0, basically. Okay, perfect. Then the call option, it says that delta moves from 0 to 1 as the stock price increases. And for put option, delta moves from 0 to -1 as the stock price decreases. Clear? Perfect. Then, so this is what we are saying. Slope here, it was -1 because the fall is happening like this, and it will become 0 like out of the money later on. So put delta is equal to call delta -1. Okay, this is also one of the equation. This is the equation. Okay, perfect. Gamma, that's the second Greek. Gamma measures the rate of change in delta as the underlying price changes. Now this is delta of delta. Okay, and gamma is in at the money, it is highest, because you can imagine the delta is changing highest when it is moving from out of the money to in the money. So deeply in the money or deeply out of the money will have low gamma, because 0 will remain 0, 1 will remain 1 for delta, right? So gamma will not change. So gamma is change in delta divided by change in spot price, students. Okay. Then Vega means the sensitivity of option prices to the changes in volatility. If volatility is higher, the value of the call option and the value of the put option, both of them will be higher. So volatility, why it is needed? Volatility is basically your changes in the prices, right? Historically, what has been the changes in the prices compared to your mean, which is also called as standard deviation here. Rho means the sensitivity of option prices to the changes in the risk-free rate of return, students. So R is also a factor, right, in the overall formula of Black-Scholes model. So if R is higher, call option will be higher and put option value will be lower. But if R is lower, the call option value will also be lower, put option value will be higher, because if you see in the formula of Black-Scholes model, this is after minus, this is before minus. Correct, the present value that is happening, so that will give the mathematical impact. Then the next part is theta. Theta is measures the sensitivity of option price with the passage of time. So t was also a factor, students. So what all things were factor? Spot price, time, volatility, and r. So four Greeks are related to these, and the another Greek is actually related to delta, which is the hedge ratio. How your hedge ratio changes is the second Greek, right? Which is the gamma. Okay, perfect. Now, quickly taking you through the credit derivatives, students. So, till now, we have discussed about the financial derivatives. So, financial derivatives are generally the ones which have market risks, which are actually trying to mitigate the market risks. For example, risks related to pricing, risk related to interest rate, stock market, exchange rate. So all these are market related. What is meant by credit risk? Credit risk are the ones where there is a risk of non-payment by the counterparty, right? So non-fulfillment of obligation by the counterparty. So here the credit derivatives are used to mitigate these risks. How? So here we have discussed about forward, futures and options. Here we will be discussing about the credit derivatives, which are the first one is collateralized debt obligations, CDO. So collateralized debt obligations, for understanding this, we will go to the securitization topic, right? Where we discuss that there is an originator, there is a borrower, these are mortgage loans. This originator assigns to SPV all these loans in the form of marketable securities. SPV will issue the securities to investors. And we also said that these are either mortgage backed or asset backed securities, right? Now, if So these originators have sold to SPV, right? Now, if you think through this, the overall portfolio will constitute like this: that 80% are okay, 80% of the borrowers are okay, 10% of them have made defaults in the interest payments, and another 10% have made default in the entire principal plus interest payments. Okay, and SPVs have issued to the investors mortgage-backed securities. So, students, we briefly covered these three tranches, if you remember, in the tranching session, in the securitization part, right? In the previous session, where we said that tranches will mean creating different series of investors who are actually getting into, let's say, the one is senior who is getting a fixed return, right? Then mezzanine is the medium return and risk. For example, this one, and equity will be high risk and high return, which is, let's say, 10%. Okay. So creating these three tranches is basically called as collateralized debt obligation. Now there are different types of CDOs. There was one question around this as well in the previous session. There is a cash CDO where the originator sells the underlying to SPV and realize cash and move away from balance sheet. Even the receivable is also moved away from balance sheet. Synthetic CDO. Only the credit risk is transferred. The entire economic effect of the credit risk is transferred, but the loan still sits in the originator's balance sheet. Okay. Then the second part is actually credit default swap. This is the second type of credit derivative, students. So the credit default swap are the ones where credit means loans, right? Default means non-payment, the default of non-payment. Swap means exchange. So there is a protection buyer, there is a protection seller. Now, protection buyer is paying premium, just like in options we were paying premium, right? To the, let's say, some percentage of the loan amount. And protection seller will agree to give protection buyer a protection which will be against any default on reference obligation. Reference obligation means the specified obligation, whatever is the specified in the contract. So initial borrowing, bonds, loans, etc. will be there. Then settlement, it can happen in two different forms. It can happen in physical form by delivery of 100% bonds, etc., or through cash in the form of differential payouts. But I hope you understood here. It is again one type of insurance that is there, right? It is again one type of insurance that is there. Clear? So there is a protection buyer, protection seller. Protection buyer will pay premium, and hence the credit default will be swapped against that premium. So tomorrow, if some default happens, the protection seller will make good that loss, basically. Clear? So I would say from derivatives, this is the overall thing that we wanted to cover. Now, are there any questions that are there that you would want to ask? I'm happy to answer them. Let me quickly check if there is some other question. So, okay, there is nothing major. So, in terms of the revisionary aspects, right? Now, if you see, we have covered the topics of forward futures options, credit derivatives, right? Credit derivatives mainly takes care of the credit risk, which is the counterparty risk. And apart from that, there are other derivatives, right? For example, the commodity derivatives, weather derivatives, right? All those things are also there. So I would say in that the only difference is the underlying, right? Rest all concepts remains as is. The discussions remains as is, right? So maybe we can now. So there are two things that we can do. We have some of the MCQs also that we can cover. Or let me do one thing. Let's go through the IRS piece as well. Let's briefly touch upon the interest rate risk management, which is going to be our next topic of discussion between today's session and the next session. Let's do this just quickly, 5 minutes. Then we will cover some of the MCQs. Then we will wrap up. Okay. Perfect. So, interest rate risk management, students. Now, this is a fresh topic, interest rate risk management. Interest is what? Interest represents time value of money. Okay, first of all, let me ask all of you, why do you think interest is paid or received? Can all of you comment or answer why do you think interest is paid or received? What is the need to charge an interest? Let me ask you this. Why do you think so there is a need to charge the interest? Yeah, to bear the risk, very good. For use of money borrowed, very good. So maybe we are trying to say that there is one, we are trying to cover the risk element, and second, we are trying to cover up for the time value of money. Yes, very good, due to inflation and risk. To get back money on resources given. Yes, Shalendra Dutt, very good. Lavanya, inflation, Jyoti, yes, all of you are correct. So if I just sum up that the reason or the genesis of interest is this, so we get these two answers or these two buckets. One, there is a time value of money, and second, there is a risk of non-payment, right? So what will happen tomorrow? There is a risk that I am undertaking. If I am giving money to someone, I am undertaking a risk. I need a return against that risk, which will happen through in the form of interest. Similarly, time value of money is something that is related to inflation, which will in, which impacts the money's purchasing power, right? For example, today if a standard basket of goods is worth 100 rupees, 1 year from now it might be 105 rupees. So it is covering up for inflation, it is covering up for time value of money. So with this, the interest is basically levied. However, now if you see, interest is a dynamic market risk, right? So interest keeps on changing because of the central bank's initiatives, because of some of the changes implemented by the central bank, or even, I mean, the RBI, or even the market forces will also keep on changing the interest rates. Now, because of this, there is a risk to the companies, to the banks, to the NBFCs, that if the interest rate moves in the opposite direction as they think, then it will lead to impacts on their interest incomes as well as interest expenses. So, since these are bound to change and these are uncertain, the overall risk management here leads to the topic and hence the discussion of interest rate risk management, students. Okay, that is why we are doing this. Plus, in this we will later on also study what are the different techniques, what are the different methods using which we can actually cover up the overall risk management. Okay, we will discuss why it is needed, and we will discuss how we will be doing it. Okay, so let's pause in here and let's go to the MCQs, right? And I would request everyone to please answer the MCQs on the chat itself, okay? So that the answers are not prompted. And I would say that all of you should answer these MCQs so that we can actually see what is the overall progress on the understanding piece, okay? Now let me share the screen. Perfect. I hope the screen will be visible. Just a second. Yeah. Let's start with the first question. Perfect. Let me read it out. A long forward contract on an asset with no income has a current forward price higher than its theoretical value. This creates arbitrage opportunity for the short forward, arbitrage opportunity for the long forward, no arbitrage opportunity, a need to revise the spot price. So just understand the question clearly. It says a long forward contract on an asset with no income has a current forward price higher than its theoretical fair value. That means in market, right? In market, the forward price is higher than the theoretical fair value. This creates what? Arbitrage for the long forward or the short forward or the other two option students. Jyoti, you have reverted. This is a tricky question. Please understand it clearly. Lavanya, you have also reverted. Sachi, you have also reverted. Again, I would read it a long forward. Now let's try to interpret it, okay? Because I have to explain this as well. A long forward contract on an asset with no income has a current forward price. That means in the market, the forward, for example, is priced at 100 rupees. Okay, let's put it a value. And they are saying it is higher than its theoretical value. So the theoretical value of forward, let's assume it to be 90. Okay. So if it is 100 and 90, 100 it is in market, 90 it is as per the calculation. Then this creates what? Can you think whether this is overpriced or underpriced? Just think through, students, whether it is overpriced or underpriced. In market, the value at which it is trading is 100 rupees. Fair value theoretically it is 90 rupees. It is overpriced. Now, what you should do if something is overpriced? Yes, very good. Jyoti, Lavanya, and Sachi, all of you are correct. It is overpriced. But what you should do if something is overpriced? You should sell it or you should buy it. You should sell it. Correct? So, A is the right answer. Arbitrage opportunity for short forward. That's the right answer. Now, coming to the second question, students, which of the following factors does not directly affect the Black-Scholes value of a European call option? Just now we have discussed, students, which of the following factors does not directly affect the Black-Scholes value of European call option? First one, volatility of the underlying. Second, dividend expected during the option life. Risk-free rate of return. And D is correlation between spot price and market index. Again, think through this. This is also a bit confusing question, right? Volatility and risk-free rate of interest. I think all of you agree these are two ruled out because these two definitely impact the pricing of the option. Now comes dividend expected during the option life or correlation between the spot price and market index. Now, what do we mean by correlation between spot price and market index, students? Let's first of all try to answer that. What is really meant by correlation between spot price and market index? What do we call that term? We have already used it in many forums. I mean, in many places. What do you call that correlation, students? That is called as Yes, very good, Saminathan. Very good, Lavanya. That is called as beta. Beta is the correlation between the spot price and market index. Have you anywhere seen beta impacting the value of the call or put option? The answer is no. So the right answer is D. Now, then the question comes, why is dividend expected during the option life not the right answer? Why? Because the dividend, the spot price that we always talk about should always be X of dividend. Okay, so hence dividend somewhere impacts. If dividend is expected to be paid, it will somewhere impact the overall value. Then, third question. The value of a futures contract on a dividend paying stock is typically spot price minus present value of expected dividend, spot price plus present value of dividend, spot price discounted at risk free rate, spot price minus carrying cost. Come on, student, this is relatively easier. So A, B, C, or D? What is the value of a futures contract, students? Correct? So the right answer is yes, very good. All of you are responding. So the right answer is A. Lavanya, you are correct. Saminathan, you are correct. Okay. Then, fourth question, delta of a call option reflects sensitivity of option price to volatility, probability of option expiring worthless, expected change in option value per unit change in spot price, or hedging ratio of gamma. This one is easier, right? This one we just now covered. This is right option here is yes, very good, Lavanya. You're right. The correct option is here. I'm waiting for others also to respond. Students, please do respond quickly. So the delta of a call option, does it reflect sensitivity of option price to volatility? No, that's Vega, right? Probability of option expiring worthless, it's nothing. Expected change in option value, yes. Yes, Sachi, you're right. It is C. Expected change in option value per unit change in the spot price. Yes, very good. Then the last question, let me just pull it up. A portfolio is delta neutral but gamma negative, a sudden large movement in the underlying asset price will likely cause the portfolio to. What they are saying is a portfolio is delta neutral but gamma negative. Okay. A sudden large movement in the underlying asset price will likely cause the portfolio to be. Maybe we can skip this question. I think this is something that we have not discussed, so let's skip this question. But I would say fairly what all things we have revised have been, in the form of MCQs that we have tested is looking out to be good. Okay, it's just that all of you need to take a further revision by yourself by covering these things up. So I think this brings up towards the end of the revisionary part of the derivatives, right? Is there anything else in terms of the questions or anything that we can answer? We are happy to take. Yeah. Uh, I think this is all from my end. I request Ashish sir, if Ashish sir, you're there on call.
Sir, Ashish sir is not here.
Okay, okay, no worries. Then maybe we can conclude the session for today. Thank you all for your patience listening. Thank you, and we will see you in the next session of the revisionary sessions where we will cover the interest rate risk management, mergers and acquisitions, and other topics. Thank you all. Thank you. Have a nice day ahead.
Thank you, sir. Thank you.
Yeah, yeah, session over technically.